Okay, today we're going to talk about risk and return, which is covered in chapter 2 of your textbook. So the first thing that I want to mention is this relationship between risk and return. So what I've got here in this chart is an ex ante risk and return relationship. And the key thing to notice here is that the market line, the red line there, is sloping upwards. And what that says is that investors expect to get a higher rate of return if they take on more risk. Now we'll see later that really all this line is this is what we call the security market line. But for right now, we're not specifying what the risk measure is, and we're simply calling it the market line. It's just the relationship between risk and return. Now, ex ante means expected. So it's entirely possible, looking back in history, that you will find examples where taking more risk led to lower rates of return. But what we're talking about here is what we expect to happen in the future. Now, understand that investors may have different perceptions or preferences regarding risk. So basically, they can be one of three kinds. Investors could be risk averse, which means that in order to entice them to take on a higher risk investment, you have to offer a higher rate of return. So risk averse does not mean that investors are not willing to accept risk. The key here is that they have to be rewarded or expect to be rewarded for any risk that they take on. Secondly, investors could be risk neutral. And this simply means that the investor cares more about the return rather than the risk. They don't really care about risk at all. They're just concerned with expected returns. And then finally, the investor could be what we call a risk lover or risk seeking. And in this case, the investor would be willing to pay to take on risk. In other words, they would accept a lower return in exchange for more risk. This would be very much like an insurance company coming to you and saying, hey, we will pay you to insure your car. And clearly, that doesn't make sense. And so we never assume that investors are risk-seeking. Once in a while, we assume that investors are risk-neutral because that can simplify some math and it really doesn't have any impact in the end. But most of the time, we assume that investors are risk-averse. And again, that simply means that they expect to be rewarded if they take on risk. So imagine if this line, this market line, was downward sloping. In other words, you expected to get a lower return if you took on more risk. Nobody would invest in risky assets in that case. So what would happen? Well, the price of risky assets, since nobody wants to own them, the price would fall, and that would increase the expected return, and eventually we would return to this equilibrium situation that is shown in the graph that I have here. So let's talk about what returns are. So a return is simply the profit, and profits can be negative, so it could be a loss as well, but it's simply the profit on an investment. Now, when we talk about returns, we can measure them in two ways. We could talk about dollars. So you could say, I invested $1,000 and I got back $1,500, so I had a $500 profit or a return. Okay, that's fair. The problem with that is that it's not easily compared to other investments, particularly if the amount invested is different. So instead of talking about returns in dollars, generally we talk about them in percentage terms, often an annualized rate of return. That way, the percentages are comparable from one investment to another, and as long as they're all annualized, then the time periods are made comparable as well. So the most basic way to calculate returns is something that we call the holding period return. This is simply the percentage change in the value of your investment over some period of time. And that period of time could be a day or a week or a year or 5 years or any period of time. Doesn't matter. So it's simply the percentage change. So let's look at an example. This is from the mini case at the end of chapter 2. The question is, what is the return on an investment that costs $1,000 and is sold after 1 year for $1,060? Well, clearly, in this case, your profit is $60, and as a percentage of the $1,000 investment, that would be 6%. So using my holding period return equation, we can calculate that in this way. Now notice in this particular simple little example, there were no cash flows. So normally we would have to sum the cash flows and add them to the ending price to calculate the percentage change. But in this case, there were no cash flows. So it's simply 1,060 divided by 1,000 minus 1 gives us 6%. So now that we know what returns are, what is risk? Well, a risk is an exposure to the possibility of a loss of something valuable. So we've got a couple of things here. We have a possibility of a loss and an exposure to that loss. Both of those are important. If you're not exposed, there's no risk. So for example, here in Denver, your risk of dying from a shark attack is 0. There's no risk at all there because I don't believe there are any sharks in the Denver area. Secondly, we have to have the possibility of a loss. We'll see here in a second, if you don't have the possibility of losing, there's no risk. If all that can happen is you experience a gain, there's no risk. There might be some uncertainty, but there's no risk. So often this loss that we're talking about is the loss of a life or a limb. So that's like the shark attack kind of an example. But in finance, mostly what we're concerned with is the loss of money, so negative returns. As I mentioned, we often equate risk with uncertainty, but that's not exactly right. So Frank Knight, about 100 years ago, wrote a book in which he explained the difference between risk and uncertainty. And essentially, risk can be quantified, uncertainty cannot. So the less certain you are of what's going to happen, the greater the risk, as long as there's a possibility of a loss. So you can imagine a situation where you're going to make $5 or $10 or $15. You don't know which, so you're uncertain. But since the only thing that can happen is that you make money, there's no risk. So this is not a risky situation. Now, as I mentioned again, risk can be quantified, uncertainty cannot. So as long as we can assign probabilities to events, then there is risk. If we simply have no idea what might happen and no way to quantify it, then that is uncertainty and not risk. Now, the other thing to be aware of is that if we know exactly what will happen, then this is a risk-free situation. And so one of the things that we're going to do later on is we're going to look at the capital asset pricing model. And the CAPM has a risk-free rate of return in it. So the return on the risk-free asset is known with absolute certainty. So that's why we call it the risk-free asset, because there's no uncertainty at all about what return you're going to get on the risk-free asset. Now, because risk is quantifiable with probabilities, we need to talk a little bit about probability distributions. So a probability distribution simply describes the possible outcomes and how they are distributed, or in other words, how they're spread around. Let's talk about two different kinds of probability density functions. So first, there are discrete probability mass functions technically. And this simply means that there is a finite number of possible outcomes. So in the PMF graph at the right, you see that there are 7 possible outcomes. Nothing else can happen. You're either going to lose 15%, lose 10%, lose 5%, make nothing, gain 5%, gain 10%, or gain 15%. There is no chance that you are going to make, say, 6% on this investment. Now, most of the time in the real world, the distributions that we deal with are continuous. That is, there's an infinite number of possible outcomes. So in this case, there is some chance that you're going to make, say, a 6% return. The problem with continuous distributions is that they're more complicated mathematically. And so what we often do is we use a discrete distribution to approximate the true underlying continuous distribution. This simplifies the math. There's no need for calculus. And so it's just easier to deal with. And in most cases, it's probably good enough. And that's exactly what we're going to do in this class. Now, the distributions that we just looked at were symmetrical. In other words, the left side looked exactly like a mirror image of the right side. But a lot of times we have to deal with distributions that are skewed. So the left does not look exactly like the right. So here's an example of a skewed distribution. This one is skewed to the left, and you notice that tail moving off to the left side. What that tells us if we're measuring the probability distribution of returns here, is that there is a larger probability of a big negative return than there is a probability of a big positive return. The distribution could also be skewed to the right, and this is exactly the opposite kind of a situation. Now, the key point here is that if you're dealing with a skewed distribution, even if it's skewed just a little bit, you have to do the math correctly and you have to account for the probabilities. A lot of times with a symmetrical distribution, we can just ignore the probabilities. Also note that human beings generally prefer positive skew, that is skew to the right, rather than negative skew. And you can see why. We would much rather have some small probability of a large gain than have a small probability of a large loss. So again, if you know the probabilities, you have to use them in your calculations. Now, whenever we talk about distributions, we need to be able to quantify them, and preferably with as few numbers as possible. In the distributions that we're going to deal with, we can usually quantify them with simply two numbers. The first is the expected return. What this is it's a measure of central tendency. That is, it tells us where the middle of that distribution is. And we can use expected returns to compare investments. The idea is that all other things being equal, we prefer higher expected returns rather than lower. And so you can see on this timeline, I have two possible investments, A and B. B has a higher expected return than A. So again, all other things being equal, all investors would prefer investment B. Now, most of the time, obviously, things are not quite this clear cut. So we calculate the expected return as simply a weighted average of the possible returns, where the weights are the probabilities of occurrence. So in this equation, you see we have rho sub t, that thing that looks like a P, that's a Greek letter rho, and that stands for probability, times the return in state t. And so we go through every possible state of the economy or state of whatever, and we multiply the probability times the return in that state, and then we sum them together. So let's look at an example from the mini case. So Congress and the President are engaged in an acrimonious dispute over the budget and the debt ceiling. The outcome of the dispute, which will not be resolved until the end of the year, will have a big impact on interest rates 1 year from now. Your first task is to determine the risk of the client's bond portfolio. After consulting with the economists at your firm, you've specified 5 possible scenarios for the resolution of the dispute at the end of the year. For each scenario, you've estimated the probability of the scenario occurring and the impact on the interest rates and bond prices if the scenario occurs. Given this information, you've calculated the rate of return on a 10-year, zero coupon treasury bond for each scenario. The probabilities and returns are shown here. So this table comes directly from the mini case, and what it shows us is that in the worst case, you would lose 14% on the treasury bond, and you've decided that there's a 10% chance of that happening. On the other hand, if we go all the way to the bottom here, in the best case, there's a 10% chance that you'll make 26%, and of course everything else in between. So in this case, we have 5 states of the economy, and we've assigned probabilities and expected returns. So this is our probability distribution. Now we can look at this graphically as well. And so here's what the distribution looks like. First of all, notice that there's a finite number of possible outcomes, so this is a discrete probability mass function. Okay, so let's calculate the expected return. So we simply take each probability times the associated return and add them together. So in this case, we have 10% times negative 14%, plus 20% times negative 4%, and so on. And when we add all those together, we end up with a 6% expected return. Now, the problem with the expected return is that we can't just rely on the expected return to choose among investments, because some investments are more risky than others. And remember, we expect that investments with more risk have higher returns. And so just looking at returns might mean that you end up taking on much more risk. And I've got the graph over at the right there. That's the same graph that we saw earlier. So we need some way that we can quantify risk. And here what we're going to do is we're going to look at something that we call total or standalone risk. And we usually measure this by the variability of the possible returns around the expected return. Now here we have two distributions, two different investments, and you'll notice that the red one is riskier because there's a higher chance that we'll have big negative or big positive returns. The important thing to note here is that generally when we talk about standalone risk, this is a symmetrical concept. So the red one, there's some chance, a small chance, but there's a chance that you might lose 30%. With the blue one, there's basically a zero chance that you would lose 30%. So we would say that the red investment, whatever that is riskier than the blue one. And this is what we want to quantify. What we're looking at here is how spread out that distribution is. You can think of it as this. The further away the possible returns are from the expected return, the greater the risk. So when we measure standalone risk or total risk, basically we can use three measures. So the first two are the variance and the standard deviation. These measure exactly the same thing. As we'll see here in just a second, the standard deviation is simply the square root of the variance. And the reason that we do that is because the variance is measured in percent squared, which is something that we're not really comfortable with. And by taking the square root, we get back to just percent. And that's a measure that we are more comfortable with. We can also calculate something called the coefficient of variation, which is just the standard deviation divided by the expected return. And what that does is that takes the scale of the numbers out of the picture. And so it's a scale-free measure of total risk. So the most common measure of total risk that we use is the standard deviation. And you can see that that's the square root of the sum of the probabilities times the deviations from the mean squared. So let's break this down just a little bit because it might look a little bit complicated, but it's actually a very simple idea. So inside the parentheses, forget about the radical, forget about the summation sign and everything. Just look inside the parentheses. What we have is a possible return minus the expected return. So this is simply how far away is that possible return from the expected return. And we're going to do that for each of these. And essentially, what this standard deviation tells us is, on average, how far are the possible returns from the expected return. Now, we do have that squared term in there, that we're squaring these deviations from the expected value. And the reason for that is that some of these deviations from the expected value are positive and some are negative. And if we were just to average them together, we would get zero. And that doesn't do us any good. So what we do is we square all of these deviations. That makes them all positive numbers. And then we can average them together. And more specifically, we calculate a weighted average because the weights are the probabilities. Now, if we don't have a probability distribution, but instead all we have is some time series of historical returns, and we'll see an example of this here in a little bit, then we can't very well say the return from 3 years ago is twice as likely as the return from 1 year ago or anything like that. So what we do instead is we assume that all of those historical returns are equally likely to occur in the future. And so you notice in this second version of the standard deviations, it's exactly the same formula, except that I've replaced the probability with 1 over n minus 1. And n is simply the number of returns that you have. You'll recall from your statistics class that the n minus 1 is simply a corrective factor for the fact that we lose 1 degree of freedom because we're calculating a previous statistic, the expected return. So the way that I've written this is what we call the sample standard deviation. Now, if we're comparing 2 or more investments together and their expected returns are different, then we might have this scale problem that I kind of referred to a little bit earlier. And generally the idea there is if you have an investment where its expected return is twice that of some other investment, just because of the scale of the numbers, we would expect the standard deviation to be higher. And that doesn't necessarily mean that that investment is riskier than the smaller one. So we calculate the coefficient of variation to correct for that, and this is simply the standard deviation divided by the expected return. Now, let's look at an example of how to calculate variance, standard deviation, and coefficient of variation. So from the mini case, we were given a probability distribution for some T-bond returns, and here it is again. We've already calculated the expected return, which was 6%. So now we want to calculate, first of all, the variance. So remember, what we're going to do is we're going to take each possible return, for example, the negative 14%, subtract the expected return of 6%, square the result, multiply the probability. We do that for each one, add them all together, and that gives us the variance. So here is the calculation. So you notice we start with 10% times negative 14% minus 6% quantity squared, plus 20% times negative 4% minus 6% quantity squared, and so on. And when we add all those together, what we end up with is 0.012. Now, again, the important thing to realize here is that 0.012, that's 1.2% squared. And percent squared is a unit of measure that most people aren't very comfortable working with. So we're going to take the square root of that to get the standard deviation. So here's the full calculation, and what we end up with is 10.95%. Is that very risky? Who knows? Until we start comparing this with something else, we can't really say. Now, the coefficient of variation is going to be that standard deviation divided by the expected return. So 10.95% divided by 6% gives us 1.83. So what this is, again, this is a scale-free measure of total risk. So we can be confident that if we compare the coefficient of variation of T-bonds to the coefficient of variation of some other investment, that's a valid comparison. With standard deviation, we cannot be sure of that. As I mentioned earlier, very often we only have historical data to work with. We don't have a probability distribution where the probabilities are specified. And so we do exactly the same thing, except that we assume that all of the possible outcomes are equally likely. That is, we give them a probability of 1 over n or 1 over n minus 1. So that the difference there is that when we use 1 over n, that's a population standard deviation. If we use 1 over n minus 1, that's a sample standard deviation. Most of the time we use the sample standard deviation, so 1 over n minus 1. However, in a lot of cases, it doesn't really matter very much. So imagine that you have 5 years worth of monthly returns. That's 60 observations. So if you use a probability of 1/60th or 1/59th, it doesn't matter very much. But in the examples that I do here, I'm going to use 1 over n minus 1. So in the mini case, we were given some data on the market portfolio, a stock called Blandy and a stock called Gormanj. And your client has asked you to use these historical returns to estimate the standard deviation of Blandy stock. Now, notice that in the book, they already did the calculations for the market and for Gormanj. So we're only going to do Blandy here, but I strongly encourage you to try to verify the results that they gave you for both the market and Gormanj. Remember, the more that you practice these calculations, the easier they will become. So the expected return for Blandy is simply the average of the possible returns. Now, I've written it out a little bit differently here, but essentially what we have is 26% plus 15% plus negative 14% and so on, all divided by 10. Or you could, the way that I've written it out, you could say 1/10 times 0.26 plus 1/10 times 0.15 and so on, and we end up with an expected return for Blandy of 6.4%. The standard deviation of Blandy, again, we're calculating this exactly the way that we did previously, except now we're using 1/9 as our probability. There's 10 possible outcomes, so 1 over n minus 1 is 1/9. That's our probability. So we take the first return, 0.26, minus the expected return that we just calculated, so that's 0.064, square that, multiply by 1/9. And then we do it all again for the second return. So we have 1/9 times 0.15 minus 0.064 quantity squared, and then we simply continue doing that for each of the 10 possible outcomes. And what we end up with is a standard deviation of 25.19%. If you look at the standard deviation for the market, it's 20.12%. So Blandy has more total risk than the market portfolio. Think about this for a second. Blandy's expected return is 6.4%, which is less than the market portfolio, but it's riskier. So which would you rather own, the market portfolio or Blandy? Well, it should be pretty obvious that you would rather own the market portfolio under these circumstances, because you get a higher return for less risk. Now, finally, the coefficient of variation for Blandy is simply the standard deviation divided by the expected return. So 25.19% divided by 6.4%, which is 3.94. If you recall from earlier, the Treasury bonds had a coefficient of variation of, I believe it was 1.83. So the Treasury bonds are considerably less risky than Blandy stock. On the other hand, the expected return on those Treasury bonds was only 6%. So would you rather own Blandy or the Treasury bonds? Well, most people probably would say I'd rather own the Treasury bonds because Blandy is a lot riskier than the Treasury bonds. However, some people, more concerned with return than risk, might prefer Blandy. And we can't say that they're irrational for that. Let's talk about portfolios a little bit. So first of all, what is a portfolio? Well, a portfolio is simply a collection of all of the assets that a person owns. So you can think, normally when we talk about portfolios, we talk about stocks and bonds and things like that. But it's actually a collection of all of the assets. So it's not only stocks and bonds, but it could be real estate. So the house that you might own. It could be cash in the bank, could be your car, etc. All of these things are a part of your portfolio. In the next couple of slides, we're going to look at a portfolio that contains shares in Blandy and Gormanj. So we have two risky stocks, and we're going to combine them together in a portfolio. As we'll see, the reason that we create portfolios is because almost always the portfolio offers a better risk-return trade-off than individual securities. The expected return of a portfolio is simply a weighted average of the expected returns of the individual assets that are in the portfolio. And so you can see the equation here. We have some weight, that's simply the proportion of the total value of the portfolio in each asset. And we have an expected return for each asset, which we've already seen how to calculate. So imagine that we create a portfolio that is invested 75% in Blandy and 25% in Gormanj. Now we already know the expected returns for both of these stocks. Gormanj was given to us and we calculated it for Blandy. So we have 0.75 times Blandy's expected return plus 0.25 times the expected return of Gormanj. So we know that the portfolio would have an expected return of 7.10%. Now, as I mentioned, by combining securities together, we can reduce risk, and we give up very little usually in terms of return. So we get a better risk-return trade-off with a portfolio. So the chart that I have here plots out the returns of Blandy and Gormanj over the last 10 years. And you can see just by looking at this chart that Gormanj is much more volatile than Blandy. So the returns bounce around a lot more. That's just another way of saying that the standard deviation of the returns of Gormanj is higher than the standard deviation of the returns of Blandy. And if you go back and you look at that table in the mini case, you'll see that that's true. The really important thing to note here is that the returns between Blandy and Gormanj are not perfectly synchronized. In other words, they don't always move in the same direction. That's the key to the risk reduction that we get by making portfolios. That has to do with the correlation of the returns, as we'll see here in just a second. Now, I've changed the chart a little bit. So I've faded out the Blandy and Gourmand returns, and I've drawn in this black line, which is simply the portfolio that we just talked about. This is 75% Blandy, 25% in Gourmand, and you can see that the portfolio appears to be, at least, much less volatile. In other words, it has a lower standard deviation than either Blandy or Gourmand. So it looks like the portfolio would be a better choice than owning either Blandy or Gourmand on their own. So let's look at an example here. So in the mini case, they tell us that your client is shocked at how much risk Blandy stock has and would like to reduce the level of risk. So you suggest that the client sell 25% of their Blandy stock and create a portfolio that is 75% Blandy and 25% in Gourmand. Now think about this for a second. What you're suggesting to your client is that they sell a stock that they're already concerned is too risky, sell part of that holding in that stock, and use the proceeds to buy an even riskier stock. To the average person that hasn't studied finance, this must sound absolutely crazy, right? So it goes on to say, show the client what the proposed portfolio return would have been in each year of the sample, so in year 1, 2, 3, etc. Then calculate the average return and standard deviation of the portfolio's annual returns. So for year 1, what we have is 75% times 26% plus 25% times 47%. That gives us a return on the portfolio of 31.25%. In year 2, it would be 75% of 15% plus 25% of negative 54%, for an overall portfolio return of negative 2.25%. So you see what we're doing? We can calculate the returns that the portfolio would have earned in each of these years, and then from that, we can calculate the expected return of the portfolio and the standard deviation. So here's the calculations. The expected return is exactly like what we did with Blandy. So we take 1/10 times the first return, plus 1/10 times the second return, plus 1/10 times the third return, and so on. And we get 7.10% for the portfolio. That's higher than Blandy's return, but lower than the return on Gourmand. That will always be the case. The expected return of the portfolio is always somewhere between the return on the lowest returning stock and the return on the highest returning stock. It's simply a weighted average, so it has to be somewhere in between those extremes. Standard deviation does not work that way. So here's the calculation of the standard deviation of the portfolio. And again, this is exactly what we've done before. We take each possible return minus the expected return, square it, and multiply by the probability. In this case, because we have historical returns, we're assigning a probability of 1/9 to each of them, and we end up with a standard deviation of 22.16%. Now, notice that this is lower than the standard deviation of either Blandy or Gourmand. So what have we done? Well, what we've got is a return that's somewhere in between, but a risk that's lower than the riskiness of either Blandy or Gourmand. In other words, by combining these two risky securities together, we've ended up with a portfolio that has a better risk-return trade-off. And if we calculate the coefficient of variation, we can see that we get 3.12. Remember, with Blandy alone, the coefficient of variation was, 3.93 or something like that. Notice also that the coefficient of variation measures the risk per unit of return. In other words, it's a direct measure of the risk-return trade-off. And this portfolio has a better, in other words, lower risk-return trade-off than Blandy stock does, and also than Gourmand, even though we haven't calculated the coefficient of variation for Gourmand, but you could do that calculation. So the portfolio is better than either Blandy or Gourmand on their own. Now, the key to this better risk-return trade-off is this idea of correlation. In other words, how do the securities returns compare to each other over time? Do they always move in the same direction? Do they always move in the opposite direction, or something in between? Most of the time it's going to be something in between. So we can quantify this in a couple of different ways that really are equivalent. So the first one is the covariance. Now notice that this is covariance. In other words, this is the same idea as the variance, except we're looking at two different securities rather than just one. So this tells us how these two securities relate to each other over time. Now, the problem with the covariance is that it can range anywhere from negative infinity to positive infinity. And because of that, that makes it very difficult to interpret. So very often, we prefer to use something called the correlation coefficient. And all that is, as we'll see here in a second, is that is the covariance standardized so that it falls into a range of -1 to +1. This makes it much easier to interpret. So -1 means they always move in the opposite direction of each other. And +1 always means they move in exactly the same direction as each other. Anything in between, is in between. It's important to note that both of these measure precisely in every way except the scale the same thing. And as I said, the correlation is easier to interpret, but mathematically the covariance is less work and generally easier to use in formulas, but they measure exactly the same thing. So here's the formula for the covariance, and what I want you to do is I want you to go ahead and write out the formula for the variance and compare it to this. Remember, with the variance, we have that deviation from the expected return squared. So if you expand that out, the formula looks very much like our covariance formula, except with the covariance, we have two different securities. In this case, we have I and we have J. Whereas with the variance, we would just have the variance of I or possibly the variance of J. So covariance and variance really are tightly related concepts. Now, the correlation, as I mentioned, measures the same thing as the covariance. In fact, if you look carefully, you'll notice that the numerator of the correlation is just the covariance. And then we take that and we divide by the product of the standard deviations. And this is just a scaling factor. And so what it does is it takes that covariance and rescales it so that it falls between -1 and +1. And since the numerator is the covariance, we can rewrite the correlation equation as the covariance divided by the product of the standard deviations. Now, let's look at the correlation graphically. This maybe will make it a little bit easier to understand. And so first of all, let's look at what the extremes look like. So here we have two stocks, stock 3 and stock 4, and they are perfectly negatively correlated. And you'll notice that when stock 3 has a high return, stock 4 has a low return, and vice versa. They always move in exactly the opposite direction. That's what perfect negative correlation means. Perfect positive correlation is exactly the opposite. They always move in exactly the same direction. So in this case, when stock 1 has a high return, stock 2 also has a high return, and vice versa. Now, let's calculate the covariance and the correlation. This is going to be very similar to what we've done before with the variance, except here we're using two securities rather than one. So let's start with the covariance of Blandy and Gormage. Now, by the way, notice that the symbol that we use for covariance is that lowercase sigma with two subscripts. That's how you know that it's a covariance and not a variance or standard deviation, because it has two subscripts, whereas the variance and standard deviation would only have one. So again, we do the same thing. We're going to take each return from Blandy minus its expected return, and then multiply by each return from Gormage minus its expected return. So for the first couple, we have 1/9. That's our sample covariance here. So that's our probability. We have 0.26 minus 0.064 times 0.47 minus 0.092. then plus 1/9 times 0.15, that's Blandy's second return, minus the expected return on Blandy, 0.064, times the second return for Gourmand, negative 0.54, minus Gourmand's expected return of 0.092, and so on through all 10 of these possible outcomes. And what we end up with is 0.01094. Now, what do we know from this? Well, what we know, because the covariance is positive, is we know that Blandy and Gourmand have some small tendency. Well, we can't say that it's small, but we know there's a tendency for them to move in the same direction because it's positive. What we don't know is how strong that tendency is, and that's what the correlation helps us to figure out. So the correlation, remember, is the covariance divided by the product of the standard deviations. So 0.01094 divided by the standard deviation of Blandy times the standard deviation of Gourmand gives us a correlation coefficient of 0.11257. So what that tells us is that there's a pretty weak positive correlation. So they do tend to move in the same direction, but that tendency is pretty weak. This low covariance and low correlation is precisely why our portfolio ended up being less risky than Blandy or Gourmand on their own. Now, from the mini case in part H, they ask, suppose an investor starts with a portfolio consisting of one randomly selected stock. As more and more randomly selected stocks are added to the portfolio, what happens to the portfolio's risk? Well, there was a famous study done by Evans and Archer back in 1968 where they did exactly this. And what they did was they picked one stock, and then they randomly picked another and made a portfolio. Then they randomly picked another and made a portfolio of 3 stocks, randomly picked another one, added it to the portfolio, so now you have 4 stocks, and so on. And what they showed was that as you add more and more randomly selected stocks, the risk of the portfolio fell. And that's exactly what we would expect. So it turns out that the average stock in the United States has a correlation with any other stock of about 0.30. In other words, the correlation amongst any 2 randomly selected stocks tends to be pretty low. And that means that if you combine them together, you end up with a less risky portfolio. The other thing to note here, and you can see this on the graph, is that standard deviation drops quite rapidly as we add more and more stocks up to a point. When we get to about 20 or so stocks, we've eliminated most of the risk that we can eliminate, and we'll talk about that in just a second. So the orange line drops very rapidly until we get to about 20 stocks or so, and then it starts to level off. It's important to note that we cannot eliminate all risk, and that's what the black line at the bottom is. You notice that there's some level of risk below which we don't go, even when we have 400 stocks together in a portfolio. So it turns out that there are 2 kinds of risk. There's what we call company-specific risk, and then there's market risk. So the risk that we are eliminating is the risk associated with company-specific factors. For example, imagine that you own shares in, let's say Boeing. Well, Boeing is a unionized company, and so there's always a chance that the employees will decide to go out on strike. And if that happens, that's going to be bad for your investment in Boeing stock. The stock price will likely fall by quite a bit. But if you also own shares in, let's say, another Seattle area company, Microsoft, well, the effect on Microsoft of Boeing's employees going out on strike is probably nil, right? And so if you have a portfolio that consists of Boeing and Microsoft, then some of that risk of Boeing's employees going out on strike is eliminated, right? That's the company-specific risk factor. And there are many other company-specific risk factors. These are risk factors that affect only one firm. That's the kind of risk that we eliminate when we build portfolios. The other kind of risk is what we call market risk. We cannot eliminate market risk. This is the risk that's due to market-wide risk factors that affect all securities. So for example, this coronavirus thing that we have going on right now affects the stock prices of all companies, not just one company. And so there's no way really to diversify away from that risk, at least not with a portfolio of just stocks. So we eliminate company-specific risk, but we cannot eliminate market risk. Now, this has important implications that we'll talk about here in a little bit. Most specifically, what that means is that the risk that you get rewarded for taking is market risk. You do not get rewarded for accepting company-specific risk. And in fact, Part I in the mini case asks specifically, should these portfolio effects influence how investors think about risk of individual stocks? Absolutely. You should not consider the total risk, but instead you should consider only the market risk. And we've already talked about company-specific and market risk. Then it asks, if you decided to hold a one-stock portfolio and consequently were exposed to more risk than diversified investors, could you expect to be compensated for all of your risk? That is, could you earn a risk premium on that part of your risk that you could have eliminated by diversifying? Well, of course not. The market is a cruel taskmaster, and it is not going to reward you for taking on risks that you can easily get rid of by diversifying. And we'll see that this is exactly what the CAPM suggests. All right, so what is this CAPM that I just mentioned? Well, it's the capital asset pricing model, and it's simply a model that we use to determine the required rate of return for an investment based on its market risk. That is, how sensitive that stock returns are to market risk factors. Here's the formula, and it says that the required return. Now, before we go on, let me mention that I'm using the same notation for required return that I used earlier for expected return. Let me mention that expected return is the return that you expect, you think you're going to get, whereas required return is the return that you need to get. Now, in equilibrium, these two are exactly the same. If the market is not in equilibrium, they can be different. So the CAPM is an equilibrium model, and what it tells us, again, is what the required rate of return should be for an investment. And you can see from the formula what this is this is the return on a risk-free asset. That's the minimum rate of return that you need to earn just because you're delaying consumption, plus a risk premium. And that risk premium depends on two things. One, it depends on how sensitive that security's returns are to market risk factors. We call that beta. Secondly, it depends on the risk premium that is available on the average security in the market. We call that the market risk premium, and that's the part in parentheses. So it's the expected market return minus the risk-free rate. So the graph here shows something that we call the security market line. All this is a graph of the CAPM's equation. The CAPM and the SML, the security market line, are exactly the same thing. When we draw the graph, we call it the security market line, or the SML. When we write out the equation, we call it the capital asset pricing model, or CAPM. But they are precisely in every way the same thing. So this is the same graph that I showed you at the very beginning of this lecture, except now we've fleshed it out just a little bit. Now, what is this beta? Well, beta is an index of systematic or market risk, and that means that it tells us how sensitive the investment's returns are to market risk factors. Or another way to say this is how risky the investment is relative to an average risk investment. And the measure of risk that we use here is market risk, not total risk. So let's calculate beta. So we're given some data for the market and for Blandy. And let me point out before we go on that the market obviously only faces market risk. Therefore, the beta of the market must be 1. That is, the market has exactly the same amount of market risk as the market, right? So beta is a relative measure of market risk. Blandy, on the other hand, is subject to both company-specific risk and market risk. The company-specific risk, remember, we can diversify away, so you're only going to be rewarded if you own Blandy for the market risk that you're taking on, and that's what we want to calculate here. So the formula for beta is simply the covariance between the security, in this case Blandy, and the market, divided by the variance of the market. Remember again, beta is a relative measure of market risk. The denominator here is the variance of the market. That's the market risk of the market portfolio. The numerator is the market risk of the security that you're looking at. So it's a relative measure of market risk. We can also write the formula for beta in terms of the correlation. So remember, the covariance and the correlation are very closely related. So we can write one in terms of the other. And if we do that, then what we have in the numerator is the correlation between the security and the market times the standard deviation of the security times the standard deviation of the market divided by the variance of the market. And if we rearrange this just a little bit and simplify, then what we have is the standard deviation of the security divided by the standard deviation of the market, in other words, relative total risk, times the correlation between the two. So let's do the calculation. The covariance between Blandy and the market, we calculate this just like we did between Blandy and Gormange earlier. The covariance between Blandy and the market is 0.02439. Now, that number is hard to interpret, but we can use it to calculate the beta. So we have 0.02439 divided by the variance of the market, or the standard deviation of the market squared, gives us a beta for Blandy of 0.6027. Now, what that tells us is that if the market goes up by 1% on a given day, we would expect, on average, for Blandy stock to go up about 0.6%. So whatever the market does on a given day, we would expect Blandy to do about 60% of that. As we saw just a minute ago, we can also calculate the beta using the correlation. So the correlation between Blandy and the market is 0.4812, and we calculate the beta from that. We should get the same answer that we got a minute ago, and in fact we do. Now, in addition to calculating the beta directly like we just did, we can also calculate it as the slope of a regression line. So you've probably seen regression analysis in one of your statistics classes. So it's simply a way that we can relate some variable to some other variable. So we fit a straight line to the relationship, and from that straight line we can draw some conclusions. So traditionally, the slope coefficient in a regression is called beta. So you might remember having beta 1, beta 2, beta 3, etc. And that's why we call beta, beta, because it comes from this regression. So here's the chart. So on the x-axis, we have the market portfolio's returns. And on the y-axis, we have Blandy's returns. And then we simply fit a straight line to those points. We call this line the characteristic line because it characterizes the relationship between Blandy and the market. And the key point here is that the slope of this line is the beta. So you can see in the chart in red, I have the equation for the line. And you notice that the slope, the first term, is 0.6027. That's exactly what we calculated the beta of Blandy to be just a minute ago. So here's what that regression equation says, really. It just says that the return on Blandy should be equal to some intercept, that's the alpha, plus a slope, which we call beta, times the market return, plus some random error term. Now, the goal of regression analysis is to find out what that intercept and that slope term are. In other words, solve for them. So you can actually do this in your calculator if you have a TI-83 or 84. So you would simply create a list of Blandy's returns and a list of the market returns and then run the regression. I am not going to ask you to do that on an exam in this class, so you don't need to do that. What I might ask you to do is to calculate the beta, but it probably is just as quick to do it by hand as it would be to run that through the calculator, given that I probably would only ask you to do it on maybe 3 returns, not 10 like we have here. Now, the CAPM can be used to calculate the expected or required return for individual securities, but also for portfolios. And so that's what we're going to do here. So the beta of a portfolio is simply a weighted average of the betas of the individual securities. So just like we saw for the expected return of a portfolio, the beta for the portfolio is just a weighted average. So we have some weights. Earlier we looked at Blandy and Gormange, and remember we had 75% in Blandy and 25% in Gormange. Those were the weights. So if we made a portfolio of Blandy and Gormange, then we would take 0.75 times Blandy's beta plus 0.25 times Gormange's beta. That would give us the beta for that portfolio. Once we have that beta, we can plug it into the CAPM along with the risk-free rate and the expected market risk premium, and we can calculate the required return for the portfolio. So in Part O, they tell us that your client decides to invest $1.4 million in Blandy stock and $0.6 million in Gormange stock. Now, let me stop here for just a second. Those dollar amounts don't really matter except to calculate the weights. Other than that, they're completely irrelevant. So we have $2 million invested in total, and so the weight for Blandy will be 1.4 million divided by 2 million. That's 70%. And the weight for Gormange would be 0.6 million divided by 2 million, which is going to be 30%. So they want to know, what are the weights? I just gave you that. What's the portfolio beta and what's the required return? And they tell us that the risk-free rate is 4% and the market risk premium is 5%. So here's the weight calculation that I just went over. And then the beta of the portfolio is 0.7 times Blandy's beta plus 0.3 times Gormange's beta. And we get a beta for the portfolio of 0.8122. So using the CAPM, the expected return or required return is 4%, that's our risk-free rate, plus the beta of the portfolio, 0.8122, times the market risk premium, which is 0.05. Remember, that market risk premium is the expected return of the market minus the risk-free rate. So we know, they didn't tell us, but we can back into this, that the expected market return must be 9%, because 9% minus the 4% risk-free rate gives us the 5% market risk premium. So if you do the math here, you find that the required return of this portfolio would be 8.06%. Now, in Part P, in the mini case, they say that Jordan Jones and Casey Carter are portfolio managers at your firm. Each manages a well-diversified portfolio. Your boss has asked for your opinion regarding their performance in the past year. JJ's portfolio has a beta of 0.6 and a return of 8.5%. CC's portfolio had a beta of 1.4 and a return of 9.5%. Which manager did better and why? Well, what we're going to do here is we're going to use the CAPM to determine the required returns and compare those to the actual returns. So for JJ, we have a required return from the CAPM of 7%. So you can see that's 0.04 plus 0.6, that's the beta, times the market risk premium of 5% gives us 7% required return. But JJ actually earned 8.5%. So Jordan Jones outperformed because he or she earned 8.5% when they only were required to earn 7%. So that's good. Casey Carter, on the other hand, using the same methodology, had a required return of 11% and an actual return of 9.5%. So Casey Carter underperformed what he or she should have earned. So Jordan Jones did better than Casey Carter. Now, we've talked quite a lot about the CAPM. And the CAPM is a wonderful little model. It's simple. It works okay. There are some problems with it, though. And because of these problems, Fama and French came up with a model where they added a couple of terms to the CAPM to try to make it work better. So there are two problems with the CAPM where it has persistently failed. And those are small stocks. So it turns out that small stocks generally earn higher returns than the CAPM says they should. And then undervalued stocks. In other words, stocks that have a high book to market ratio. These are undervalued. So undervalued stocks tend to perform better than the CAPM says they should. So these two problems are persistent. They always seem to be there in the data. And so Fama and French took the CAPM and they added two additional terms, one to account for the size of the company and one to account for the book to market ratio. And so in 1992, they published this model where you can see we've got essentially on the right-hand side, we have A, which is the intercept, plus B, which is just another word for beta, times the market risk premium. That's the CAPM. The first couple of terms are the CAPM. Then we have C times the average return on a portfolio of small stocks minus the return of the portfolio of big stocks. So SMB stands for small minus big. Don't worry about exactly why that's termed the way that it is. This is simply the additional return earned by small stocks minus big stocks. And then we have plus D times the average return on a portfolio of high book to market ratios minus the return on a portfolio of low book to market ratios. Again, don't worry exactly why that is. The way to think about this model is it's the CAPM plus two additional terms. Now, it turns out that this pretty much eliminates the problem with small stocks and undervalued stocks in historical data, but it doesn't do a very good job at explaining required future returns. And so the CAPM actually does a better job with explaining required future returns than this model does. So the Fama and French model has become fairly important, but the CAPM is still used probably just as much. All right, now I'm going to take a look for a few minutes. I'm not going to spend a lot of time on it, but I'm going to take a look at the quantitative questions in the mini case. So I'm going to look at the spreadsheet that's available up on Blackboard for you. Okay, what you're looking at here is the spreadsheet from the mini case in Chapter 2. So I've put this together. Hopefully you find it helpful. Remember, one of the things that I think is very important for success in this class is for you to work through the mini case. I understand that that's additional work because you have to read the chapter, do the homework, do the mini case, etc. But again, I can't stress enough, practice is very important. And also the questions that are asked in the mini case will help to focus your mind on what the most important topics are. So I've created these spreadsheets. I have one for each of the mini cases that have quantitative questions in them. And this one is for Chapter 2. Now, let me again tell you that you don't need to understand Excel. The idea here is that you can look at the data and see the answers so that hopefully you can reproduce these answers when you do them by hand yourself. This is not an Excel class, so you're not expected to understand all the formulas or, be able to do the work in Excel. You need to be able to do the work by hand or on your calculator. And so I have the mini case here. You see that I have the questions in column A are labeled. So the first question was about if you made an investment of $1,000 and you later sold it for $1,060, what was your return? That was 6%. And then we had the probability mass function for the treasury bond returns. So I give you that, and we calculate the expected return, the standard deviation, and the coefficient of variation, and so on. And so I just wanted to real quickly here take a look at this spreadsheet so that you can see what's available up on Blackboard. We've already been through, I believe, all of these quantitative questions in the lecture itself, and so I don't think I need to go through the spreadsheet here right now. I just want to show it to you and tell you that these spreadsheets are available up on Blackboard for all of the chapters, and so you have access to these to help yourself with practicing the problems. Okay, I think that's good enough for Chapter 2. Next time I will have a video on Chapter 3. I hope that you found this to be useful.